Hey, Bulls and Bears, we are back, and we are back with some big news as usual. Following the financial economic news lately has been definitely a lot more interesting than the last few years. Well, I shouldn't say that. 2020 was pretty wild with everything that happened with the shutdowns and supply chains and the world going crazy pretty much. But here is some news here that we need to stay on top of. Barclays is warning of a second wave of deposit outflows, also known as bank runs. Quote, we think the first wave of outflows may be nearly over, but recent tumult regarding deposit safety has now awakened the sleepy depositors and started what we believe will be a second wave of deposit departures with balances moving into money market funds, unquote. Now, we told you that this is waking up a lot of people and alerting a lot of people that didn't really used to follow these things, right? People are just now finding out that the banks are technically insolvent. They don't have the money that they take in. They get rid of it. They invest it. They use it to buy back their own stock. They use their profits to buy back their own stock, to pump up their own stock price. That way, people that have the stock can get rich, and a lot of those people are people that work at the banks, and of course, big money markets, hedge funds, investors, etc. So it's a big game. It's a big game of taking a little money and making a lot of money out of it. So the question is now, how many more banks are going to go down? How big will the backstop be? Will they just add it on to the what seems to be endless mountain of debt and keep this entire failed system propped up? Or will we see a lot more bank failures? Well, we know that the winners and the losers are going to be chosen based on which institutions are considered systemically important institutions, right? So that's what makes it very difficult. There's no set rules. The rules could change at any moment. The goalposts could change at the snap of a finger with one emergency meeting, which we've already seen happen here over the past few weeks. So without knowing the rules and without knowing the guidelines and when the guidelines are going to change, it's very, very difficult to tell exactly what's going to happen, what to do. So overall, I would just encourage caution investing where you keep your money. There's a lot of different opinions out there on where you should keep your money at right now. Some people say the small banks are still the safest because they're not as leveraged. Other people say, no, they're the worst. They're the most risky because they're not going to have the guaranteed backstop of the money printers. So not easy, regardless, not easy to figure out exactly what to do here. Also, opinions greatly vary, widely vary on if we should even have FDIC protection for deposits. Because what that does is that makes people less diligent, right? So when people think their money's protected, they'll just pick whatever bank. It doesn't matter because it's all protected. Instead of picking the bank that's going to be the most safe with their money, the safest, and pick the bank that has the best balance sheet as far as how much money they loan out versus how much they have in deposits, right? It would also encourage banks to give a higher interest rate, higher APR or yield on deposits. That way, banks would need your money to loan it out. So the more responsible banks would actually offer the better deals because they're going to incentivize people to put the money in their institutions. Therefore, they'll have money to loan out. But the banks that just loan out money, regardless of how much they have in deposits, they don't have to offer you a higher APR to get your money into the bank because they're loaning it out anyways, right? So FDIC, when you look at it, the whole system of this, what people call a safety net, is actually discouraging people from doing their due diligence and looking for a good bank and just parking it wherever with whatever bank. So you could actually say FDIC actually harms the entire banking system when it's spoken of as a way to protect people, but it really does more harm in the end. And we see that with a lot of things. A lot of things that were meant to help end up doing a lot more damage, right? Am I the only one seeing that? I think we all can agree on that. Things that are supposed to help end up doing a lot more damage. Look at all the renter protections that started taking place a few years ago in 2020. Has that helped rent become more affordable for people? No, rents have gone up a lot. I mean, they dropped here just this past few months a little bit, but we're still way up from where we were when this rent inflation began, mid 2020. And what can you name that's really helped people in the long run, right? A lot of these things are temporary fixes, and they don't do any long-term good. In fact, they do a lot more damage. Now, there's a large number of folks in the camp that say there's going to be a huge number of banks that are going to fail, that they're going to just, the decision makers are going to let them fail. They're not going to rescue the banks. Even though they may give the depositors their money back, the banks are ultimately going to fail or be taken over. But when banks are taken over, they're still operational. So that's not deflationary, because just because a bank changes names doesn't mean that it's going to be harder to get a loan, because the bank's still going to be there to give out loans, right? So that's going to be inflationary the more banks are rescued. Now, the more banks are allowed to fail and disappear, and what I mean by that is not get bought out and get changed over to a new bank or get under the umbrella of a bigger bank, just fail completely and go away. That would be deflationary, because then it would be harder to get loans. And you could say that the too big to fail banks would make up the slack for it, but ultimately the consensus is that that would be deflationary. But not everybody feels that way. Here's someone, and you've all heard of him. He says there's going to be massive inflation. Let's give you a quote here from Peter Schiff here. He just put this out recently. The U.S. banking system is currently insolvent thanks to the Fed and the FDIC. Banks were much sounder under a gold standard prior to the FDIC, of course. 18 trillion in deposits insured by 100 billion in treasuries. The value of all bank deposits will soon be destroyed by inflation. So, unquote, by the way. So he's in the camp that says there's going to be massive inflation, that there's going to be all this new money creation to prop up the failed, insolvent banks. And what do you think? Do you agree with Peter? Is it going to be inflationary, or do you see a lot of banks failing and therefore tightening of the lending standards causing deflation? Remember, the tougher it is to get a loan, the lower prices go. And you can see that right now in the housing market, right? With the higher interest rates, higher mortgage rates, home prices have started to come down. So please let me know what you think, which way it's going to go. Now, also, what we're seeing here is, in many cases, big banks come in to rescue little banks, not just buy them out, but rescue them and just inject liquidity into the little smaller banks or the regional banks that are suffering bank runs. Well, that's not a good thing either, because even the big banks don't have the money to do it. They're just leveraging more debt is what they're doing. They're leveraging more debt, the same as they leverage when you get a loan. They're loaning out more money than they have. So this is just more leverage. It's not a solution. People say now that the big banks, they look safer because they see these headlines like 11 large U.S. banks decided to supply $30 billion in liquidity to First Republic banks. We saw that headline recently. So then that gives even more confidence, or people get more confidence in the big banks. They say, oh, look at that. The big banks are coming to help the small banks. They must be great, and they must be very well run. Well, no, it's not that they're very well run. It's just that they have more leverage capability to go in and rescue those banks because they're too big to fail. You see what I'm saying here? So what's looked at as confidence is actually just more insolvency in disguise is what it is. Now, let's paint the big picture here. Here's what I think is going on. The entire U.S. banking industry is being prepared for a takeover, a federal takeover, and they're going to usher in a new monetary system. That's what's happening, in my opinion, and I think a lot of you agree with me that that is happening. So what do we need to do? Well, have some valuables out of the system. And yes, I'm talking about precious metals again. Many people believe that's crypto. If you think you're in a safe place with that, then good luck to you. Hard wallets, offline wallets are the safest place in my opinion. That's where I keep mine. So the question is, once so many other platforms go down or get regulated or get fined out of existence, will there be a market for these currencies, these digital currencies, right? So to each his own. That's my opinion here. I feel safer with the hard assets out of the system. My favorite thing is still silver. Also silver IRAs, as I have a sponsor that does that. So that's where I've maneuvered myself here. So we have to be safe in this environment, because this is a whole new ball game that's coming up here, and it's not going to be very good for those not paying attention. Also, what's come out recently in some of these hearings Some of the bankers have gone before Congress and they're being questioned. I've showed some clips here on this channel. Some of what's coming out is they're blaming the digital systems that people have, the online banking, etc. They're blaming the digital system, the online access to their accounts, the availability to move money at the click of a finger, at the click of a mouse, or on your phone. They're blaming that as the reason for the bank runs. Well, no matter how you access your money, whether it's online or you go into a branch, if you take your money out, it still doesn't change the fact that the banks are insolvent. So even if there wasn't the online access to your bank account, which people didn't have for the most part 20 years ago or more, even if it wasn't for that, the banks still need to have the money in there to be able to loan it out, and they don't. And that's what happens when you have this fake system of money, right? So ultimately, we're going back to a hard asset-backed currency. It's going to be precious metals backed at some point. That's my opinion. But I think before we get there, there's going to be another failed system that's going to be implemented, and I don't think that one's going to last very long. That's going to be the all digital currency. It's going to come with a lot of negatives, a lot of downside. So what can we do? Be prepared, be on top of it. Stay on top of the news by following me here. Please give a like and subscribe if you haven't already, and come back for more updates. Otherwise, keep stacking. Bye for now, everybody. Peace.